LoanDepot stock, ticker LDI, just capped off a brutal week. After falling almost 10% on Thursday, the stock followed it up with another heavy sell-off on Friday, dropping 79 cents to close at just $3.72 per share. That's a loss of more than 17% in only 2 trading sessions. For a stock that had been trending on Reddit, buzzing on FinTwit, and even catching mainstream attention after Citron Research called it a hidden gem, this reversal has left a lot of traders wondering, was all the excitement around LDI just a flash in the pan? Or is there more going on beneath the surface? The short answer is this: insider selling spooked confidence. While Opendoor, ticker Open, has insiders stepping in to buy stock, LoanDepot insiders have been selling. And when you put that against a backdrop of profit-taking after a big run-up, plus fragile retail sentiment, you get the kind of steep sell-off we just witnessed. So today, let's break down exactly what's happening with LDI. We'll cover who's been selling, why that matters, what else is going on with the fundamentals, and whether this really means LoanDepot's popularity is short-lived. First, the insider sales. Over the past few months, we've seen a steady drip of disclosures showing LoanDepot executives cashing out of their shares. The CEO, Anthony Hsieh, has sold sizable amounts. Other executives like Jeff Walsh, the president of LDI Mortgage, have also sold. And most recently, filings show Dan Binowitz with a proposed sale of 50,000 shares, following hundreds of thousands more sold in prior weeks. Now, not all insider selling is sinister. Executives have personal reasons to diversify. They may sell to cover taxes. Many use prearranged plans, called 10b5-1 programs, that schedule stock sales in advance regardless of market conditions. Some of the sales we've seen at LoanDepot fall under that category. But in the stock market, optics matter. And the optics here are bad. When insiders are unloading stock in large amounts at the same time retail chatter is pushing the name higher, it looks like they're cashing in on the hype. That doesn't build confidence. Compare that to Opendoor, where insiders have actually been buying shares. To retail investors, insider buying says, "We believe in this company's future." Insider selling says, "We're taking money off the table." That contrast is part of why LDI looks shaky right now while Opendoor has been holding up better. Second, we have to talk about profit-taking. LDI stock had a big rally in recent weeks. Remember, Citron Research put out a bullish call, arguing that the company's mortgage servicing portfolio was worth about $5.50 a share on its own, which is above where the stock has traded even during its recent highs. Add in the Fed's 25 basis point rate cut and the possibility of 75 basis points more this year, and suddenly you had a retail narrative forming, undervalued asset, improving macro backdrop, bullish influencer, and chatter heating up online. The stock moved up accordingly, with daily trading volumes climbing and mentions surging on Reddit. But when a small-cap stock rallies on sentiment, it's vulnerable to sharp reversals. Traders who bought in at $3 or $3.50 looked at $4.50 or higher and saw quick profits. When the insider selling news dropped, it gave them the excuse they needed to hit the sell button. That combination of nervous retail sentiment plus profit-taking created a cascading effect. Once momentum swung, the downside snowballed. So, was this purely a sentiment-driven crash? Not entirely. The fundamentals haven't suddenly collapsed, but they also haven't changed enough to provide a floor under the stock yet. Let's revisit what the fundamentals look like. In its most recent quarterly earnings, LoanDepot showed some encouraging signs. Revenue was higher. Margins improved. Net losses narrowed compared to previous quarters. The company had $409 million in cash on the balance sheet, providing liquidity and some breathing room. And Anthony Hsieh, the founder, returned as CEO, which brought a measure of leadership stability. Those were the factors that made Citron's bullish case plausible, that the servicing portfolio was undervalued, that the company was stabilizing, and that rate cuts could be the macro spark to reignite growth. None of that has changed. But what has changed is sentiment, and in stocks like LDI, sentiment is everything in the short term. So, is this just hype fading? Is LoanDepot another meme stock that had its moment and is now destined to drift lower? Here's why the story is more nuanced. On the one hand, the case for a flash-in-the-pan narrative is strong. The rally was sparked by a third-party call from Citron, amplified by social media chatter, and reinforced by macro headlines. That's classic retail momentum. When insiders sold into that rally, confidence cracked, and retail enthusiasm evaporated fast. If the stock doesn't have a steady institutional bid or durable fundamentals to support it, it can indeed look like the excitement was temporary. On the other hand, there are still reasons to believe LDI could have staying power. First, the servicing portfolio is a real asset with recurring cash flow. Citron wasn't making that number up. It may or may not be worth exactly $5.50 a share, but it is worth something significant, and the market may still be undervaluing it. Second, the macro backdrop is shifting in LoanDepot's favor. If the Fed continues cutting and mortgage rates drift lower, refinancing and origination activity could pick up, directly boosting LDI's revenues. Third, the company is moving in the right direction financially. Losses are narrowing. Liquidity is strong. Leadership is stable. That doesn't guarantee a turnaround, but it does mean there's a foundation. If the company can execute, by controlling costs, growing originations, and capitalizing on servicing income, then the stock could recover. In that case, this sell-off may eventually be seen as just another painful correction on the way to longer-term gains. It's also worth pointing out the contrast with Opendoor again. Opendoor insiders buying stock sends a positive signal. It shows confidence. LoanDepot insiders selling sends the opposite. But sometimes, those optics can overshoot reality. If insiders are simply following prearranged sales programs or diversifying, the market reaction may be exaggerated. If, on the other hand, insiders keep selling aggressively without any buying, it will continue to weigh on confidence. That's something investors should monitor closely. So, what's the big picture takeaway here? The heavy sell-offs on Thursday and Friday were not the result of some catastrophic new development in LoanDepot's business. They were the result of fragile sentiment breaking down under the weight of insider selling headlines and profit-taking. That makes this more of a psychology story than a fundamental one. For short-term traders, that means volatility will remain high. Expect big swings, both up and down, depending on the news cycle. For long-term investors, the key is to focus on the fundamentals. Is the servicing portfolio undervalued, are financials continuing to improve, and is the macro environment becoming more favorable? If those boxes are checked, then the current pullback might be more of an opportunity than a death sentence. But we have to be clear about the risks. LoanDepot is still not profitable. It's highly sensitive to interest rates and mortgage demand. Housing affordability remains a challenge, and consumer confidence is not a given. Execution risk is real, and insider selling is not helping confidence. So, was LDI's popularity just a flash in the pan? The honest answer is, it depends. If this was purely retail hype riding on Citron's call, then yes, the rally may prove short-lived. But if LoanDepot can continue to stabilize financially, if the Fed continues to ease, and if refinancing demand picks up, then this stock still has the potential to surprise people. The current sell-off doesn't change that. The smart approach is to treat this as a sentiment reset. The hype phase is over for now. The stock has to prove itself on fundamentals. That's where the next chapter of the story will be written. So as we look ahead, keep an eye on three things. 1. Insider activity. Do we keep seeing big sales, or do we finally see an insider step up and buy? 2. Macro conditions. Do mortgage rates actually fall in response to Fed cuts, or do yields stay sticky? And 3. Financial execution. Do revenues continue to grow, losses continue to narrow, and liquidity remain strong? If the answers to those questions are positive, then LDI's story is not finished. If they're not, then the stock may fade back into obscurity as just another name that had a brief moment in the sun. At the end of the day, the real story here isn't just about a 7 to 9 cent drop on a Friday. It's about whether LoanDepot can bridge the gap between retail hype and long-term value. That's what investors should be watching.